before we get into it, wanted to do some quick introductions. I know a lot of you that's attending here today, but for those of you who don't know me, my name is Taylor Morgan. I'm one of our advisors here in our McLean County office. And then joining me today from Bloomington as well, I have Matt Lage. He's an advisor on our team as well. And then I also have Kathleen Edgecombe, who's joining us from Decatur. She runs our resource team, which consists of the tax team and the financial planning team. So she is just a wealth of knowledge. She's a certified financial planner. She's been in the financial services industry for about 30 years now. Kathleen, how long have you been with Busey for?
29 years now.
Okay, perfect. So yeah, we're happy to have Kathleen join us today. Kathleen and I are going to kind of split this presentation. I'm going to do a lot of the high level stuff, and then whenever we get into the nitty gritty details, I'll kick it over to Kathleen to share her knowledge on that stuff. Couple housekeeping items as we're going through this. There's a chat box in the bottom right. Feel free to ask any questions that you have as we're going through the presentation. We'll try to address them as they come up, but if not, then we'll get to them at the end of the presentation as well. Matt will be monitoring that for us too, so he'll keep a list and he'll interject whenever one's pertinent for us to address in the slide that we're presenting. So with that, we can go ahead and get into it here. Just want to make sure, can everyone see my screen here? Matt, Kathleen, can you give me a thumbs up if you can see it? All right, perfect. So yeah, this is our first installment of our workshops for 2025. We figured tax planning would be a good one to start with, meaning we're in the throes of tax season right now. We appreciate Kathleen joining us here because we know she's very, very busy right now with all the tax prep that her team's doing. Quick disclaimer, this material is intended for informational purposes. It's not intended to be relied on for tax or legal or investment advice. So any specific questions that you have for your situation, you should definitely defer those to your own CPA. But we're happy to address kind of questions and generalities for you. So first, I really just wanted to start off with some of the changes we've seen here over the last couple of years. This information might not be new to all of you, but back in 2020, the Secure Act came out, and what that did initially was it pushed RMDs back to age 72. So prior to that, required minimum distribution started at age 70 and a half for your traditional retirement accounts. And it also put into place the inherited stretch or the 10-year rule for inherited IRAs. So prior to that, whenever you inherited an IRA, you had to stretch those distributions out over your lifetime. After the Secure Act in 2020, that changed to a 10-year rule, which there was some misconception about how that worked when it initially came out. So I'll have Kathleen touch on that here in a little bit, but there's only a few exceptions to that 10-year distribution rule. One of them being a spouse. If you're a spouse and inheriting an IRA, you're essentially just going to take that over as your own. Another one being a minor child of the original account owner, disabled individuals, chronically ill individuals, or individuals that are 10 years or more younger than the original owner. Fast forward to 2023, RMDs got pushed back again. So as of now, their RMD age begins at age 73. That pushes back to age 75, though, starting in 2033. Another big thing that did was it changed some of the rules around failure to take your required minimum distribution. So prior to this, if you didn't take your RMD in a year, you were imposed a 50% penalty on that. That changed this time around they reduced it to 25%. And then if you correct it within 1 to 2 years, then that can get lowered down to 10%. So gave a little bit of relief for people that inadvertently missed their required minimum distributions. One of the big things I'll point out here, and this isn't directly related to the Secure Act, but for your first required minimum distribution that you take, you can actually delay that into the following year. You just have to take it before April 1st in that following year. So let's say you turn 73 in 2025. Then you have until April 1st of 2026 to take that first required minimum distribution. But you also have to take your 2026 RMD in that year as well. So you could be doubling up on income, and it could bump you up into another tax bracket. So just something to be mindful of there. Kathleen, could you talk a little bit about the 10-year rule? I know there was a lot of misconceptions around it when it was initially rolled out, and the IRS wasn't really, they didn't really vet the idea fully before they pushed it out. So if you wouldn't mind talking about that a little bit.
Thank you, Taylor. Yeah, I think you summed it up really well there, that it really wasn't fully baked when they rolled this rule out. And it actually took years for regulations to finally be in place, shall we say. And so in essence, if you inherit an IRA and you don't meet one of these exceptions that are listed on this slide, then you are required to take out that full balance within 10 years of the date of death of the person that you inherited from. And there was a lot of misconception about, well, do I have to take it out, some out every year as a required minimum distribution, or can I take it out as I want to, as long as I get it out by the end of the 10th year? And there was no real guidance, but now we have guidance. There is an RMD that is to be taken out for folks who inherited IRAs beginning in 2020. If you did not take an RMD from an inherited IRA in these first few years, you will not be penalized for not having done that. It does not stop the clock on the 10 years. So now you have to play catch up. If you have not been taking out distributions from that inherited IRA, then now you should be receiving a letter from the custodian that says, here is your RMD for 2025. And we're not going to get into the calculations because they are mind-boggling. Let's just leave it at that. But you do need to begin to take distributions, required minimum distributions that are calculated each year, beginning in, I think they actually kicked the can down the road again. You don't have to start that until 2026, I think, but it may be 25. Again, the numbers change. But at this point in time, if you have inherited an IRA in the last 5 or 6 years, you need to be making sure that you are getting those distributions out each year.
Yeah, I think it's important to note that those required minimum distributions aren't enough to actually take the whole amount out within 10 years. So just being mindful of that. It's just a minimum amount that you have to take out. You can take out more than that if you wanted to, take 1/10 of the account out each year to deplete it after year 10. You can do that. You just have to take that minimum amount out, but that won't reach the full balance of it.
And Taylor, that's a really great point, that you need to be taking that into consideration as you are doing your tax planning. If you are still in the workforce, for example, and you know that you're going to leave the workforce in a year, then maybe this year, because you've got higher income, you only want to take that minimum, and then you can adjust the amounts in those later years once the rest of your taxable income has gone down. So tax planning is still available with that, and it varies from person to person.
Thanks, Kathleen. So next, just wanted to talk a little bit about the basics about traditional accounts and Roth accounts. So as most of you know, traditional accounts, whenever you're contributing to them, you're getting a tax deduction on that amount that you're contributing typically. Those distributions, whenever you take them down the road, are subject to income tax. Traditional accounts are also subject to RMDs, and as I mentioned before, RMD age right now is age 73, and that's going to change to age 75 by 2033. One of the cool things that you can do with traditional accounts, and we've talked to the group about this quite a bit, is qualified charitable distributions. And we'll go through those in a little bit more detail on the next slide here. But I just wanted to point out while we're here that qualified charitable distributions can only be made from your IRA. So if you still have funds inside of a 401k, you can't make those qualified charitable distributions from that. It has to be from a traditional IRA. With Roth accounts, the distributions are generally not subject to income taxes. There are some stipulations around that, one of them being the 5-year rule. So your Roth IRA needs to be opened for 5 years, and you also need to be 59 and a half. Anything that you contribute to those Roth IRAs, you can always get that back out tax-free. It's really just the earnings of that account that can then be subject to taxes or penalties on it. Once you turn 59 and a half, the penalties are going to be wiped out. Then you're just subject to taxes if the account hasn't been open for 5 years. But as long as you're meeting that 59 and a half rule and the 5-year rule where the account's been opened for that long, you can get the full amount out completely tax-free. They're also not subject to required minimum distributions unless they are going to be inherited. Once you inherit a Roth IRA, you do have to take required minimum distributions from it. That doesn't mean that you're taxed on those required minimum distributions, but you are required to take some funds out of those. And then, sorry, my screen just went black on me here. Give me 1 second, bear with me here.
And one thing that is in the fine print on that slide that I would just add is that all the things that Taylor just ran through with regard to Roth IRAs and the distributions being tax-free if you meet the holding requirements and the age requirements, that is all under current law. So that is something I know both Taylor and Matt have heard me say more times than they can probably count, because tax law is constantly changing, and it does not mean that they couldn't change the rules regarding Roths. Do I think they will? Probably not, but it's just something to take into consideration as you're doing your planning and evaluating whether or not a Roth conversion or something along those lines might be appropriate.
Yeah, and the last thing on this slide is just that Roth 401ks are no longer subject to required minimum distributions. So I don't know if this necessarily applies to a lot of the people in this group, but Roth 401ks are becoming a lot more common in the industry right now. And prior to 2024, they were actually subject to required minimum distributions if those funds were left in the 401k. So they did make that change where you're no longer required to take those amounts out. Okay, now we'll get into qualified charitable distributions here. I know I mentioned them briefly on the last slide, but essentially what a qualified charitable distribution is it's taking money directly from your IRA and gifting it to a charitable organization. That charitable organization must be a registered 501c3, and you have to be 70 and a half or older to do these QCDs as well. So that means you can start doing QCDs before you actually reach your required minimum distribution age of 73. Now, Kathleen, what is the benefit of doing that? Because if you're not required to take that money out of your IRA, then what would you be making the QCD for at that point?
There are actually a couple of points that I would make with regard to that. And this is a planning technique that we use quite a bit in financial planning. And that's where you are assessing not only your current situation, but looking forward into the future. And while none of us have a crystal ball, it is a reasonable hope that money that you have in an IRA will grow over time. And the more it grows, potentially the larger your required minimum distribution will be when you get to that age, whatever that age is. So one of the planning techniques that we do is we evaluate what we think that first year RMD will be, and even beyond that, and then say, all right, if you don't think that you are going to need all of that income when you start taking the required minimum distributions, then should we start taking some of it now before you are actually required to, and do a QCD? If you are philanthropically inclined, this can be a great way to help charities that you're involved with or that are close to your heart. You can do that. And then what you are doing is potentially reducing future required minimum distributions, which will be taxed to you. You're helping a charity that is important to you, and you're doing it in a manner that is not going to impact your current tax situation. So you've got that whole aspect of income tax planning now, not adding to the situation and potentially benefiting you in the future. The other aspect of this that can be very good is the fact that if you are doing a QCD, even before your RMDs are required, you're moving that money out of your taxable estate. And estate planning and tax planning actually go hand in hand. So those are the two primary things that are important considerations beyond just the fact that you are helping a charity.
Yeah, and really the biggest benefit of this is once you hit RMD age, the amount that you're gifting to those charities is directly reducing the amount of your adjusted gross income. So let's say you have a required minimum distribution amount of $10,000. If you take that money to you, you're going to be taxed on that whole amount. If you gifted $5,000 of that directly to a charity, you're only going to be taxed on $5,000 of that. And you can gift up to $108,000 per year on these QCDs as well. So even if that's above what your required minimum distribution is, that's the max amount that you can do. So if you do have large RMDs in the future, it might be beneficial to start reducing the amount in your traditional buckets to reduce the tax liabilities down the road. Kathleen, from a tax reporting standpoint, can you talk about that as well as kind of how it plays into deductions on a tax return? Because I think a lot of times people think that whenever you're gifting money from a QCD, you can actually itemize that. So I wanted to talk through what that looks like.
Yes, and that is a common misconception. And unfortunately, you cannot double dip. You cannot exclude it from your taxable income and take a tax deduction on top of it. And so what you see is that QCD goes, as Taylor said, directly from the IRA to the charity. So it never crosses your hands in essence. And it is, if you took that $10,000 distribution that you have to take, and as Taylor used in his example, you do $5,000 to directly to charities, and it doesn't have to be one, it can be multiple charities. And then you're still going to see that you're being reported, the reported amount is going to be that $10,000. And so we're going to talk about what that actually looks like on the 1099-R that you would receive. and what you need to do when you're filing your tax return. But the other thing is, and this is what Taylor was alluding to, is that not everyone can itemize. And under the current situation, which is set to expire at the end of this year, your exemption for filing on the federal side basically doubled the standard deduction of prior to Tax Cuts and Jobs Act. And so many people can no longer itemize. And if you are gifting to charities, you may not have enough to itemize. And it's great if you just want to give to charity, but if you also want that tax benefit, if you are not itemizing and you are over 70 and a half, quite frankly, the QCD is the way to go, because then you do get an advantage on your tax return in that that income is not taxed to you and it goes to the charity. And also, by keeping your adjusted gross income as low as possible, that may make you eligible for other tax deductions if you are able to itemize things that are based on a percentage of your adjusted gross income, like medical expenses. So I know that gets a little bit confusing there. And one of the things that we find as tax preparers that confuses people the most, and not just individuals who are preparing their own tax returns, but sometimes even tax preparers have to stop and think about this or question it, because you need to keep track of those QCDs that you make throughout the year, who it went to and how much, because this is not reported on your 1099-R. So if you are having someone prepare your taxes, you need to provide them with that information. And so I want to show you what your 1099-R would look like if you did a QCD. So this is the 2024 1099-R. Hopefully by now you are receiving those for any distributions that you did receive during 2024. And you can see here in box 1, it shows that $10,000 distribution that Taylor used as the example. Box 2A also shows $10,000. It does not reflect the reduction of the amount that went directly to charity. And this is why it's incumbent upon you and critical if you want to get the tax benefit to make sure that you're tracking those amounts throughout the year. There is no place on the Form 1099-R for a trustee or a custodian to report the amounts that you directed them to give to charity. And that is a common misconception. We hear it from people all the time this time of year. And so it's really important to see that it's your responsibility, you as the taxpayer, to keep track of that. And then I want to show you what it actually looks like on your tax return when you do that. So here you can see in this example, box 4A, there were $17,119 in total IRA distributions, not pensions, not anything else, IRAs. And that goes back to the point that Taylor made earlier, which is you can only use an IRA to make a QCD. But then when you go over to box 4B, which is right there, it only shows $12,419. So the QCD, those letters there, indicate that $5,000 in this situation was made directly to qualified charities. And that is how you get the benefit. I always tell people, if you do a QCD, it doesn't show up on your tax return. It shows up in that box 4A, but it doesn't show up in the important box, which is 4B. And that's what goes into the calculation of your adjusted gross income and your taxable income.
Yeah, so, I can speak for a lot of the clients that I have here that do QCDs, and typically what they do is at the beginning of the year, they will reach out to us and ask us for the list of the qualified charitable distributions that they've done over the last year. That way we can send that to them, and then they can pass that along to their tax preparer, just to make it easy on them. So you should be, you can track it yourself. You can reach out to your advisor to get that, really whatever works best for you and your situation. So another thing that has become very prevalent in a lot of our conversations is Roth conversions. And, historically, one of the ways that Roth conversions were used the most was really to reduce those required minimum distributions going on into the future and give people kind of a tax-free bucket of money down the road in retirement. So at its core, what a Roth conversion is it's taking money from your traditional retirement account, pulling it out, paying the taxes on it, and then moving it into a Roth IRA to provide for that tax-free bucket in the future. Important thing to know here is you do pay the income taxes on it when you're pulling it out of your traditional IRA, but it could be really beneficial down the road. As of late, especially with the change in the inherited IRA rules, condensing that down to 10 years, we've used these conversations a lot around estate planning and legacy planning for the next generation. As we mentioned before, whenever you inherit a traditional IRA, you have to take those funds out in a 10-year time frame. So that could have some negative tax implications on the next generation, especially if they're in a really high tax bracket. So a lot of the conversations we've been having with clients is, would you rather pay the taxes on this yourself, or would you rather the next generation pay the taxes on it? And, we have some clients that say, we've worked our whole lives for this money. The next generation can pay the taxes. We don't care about them. But then we have other clients that are along the lines of, we don't really need all of this money. We'd prefer to pass on kind of a tax-free bucket of funds to the next generation. So that's when, a Roth conversion might make sense for legacy planning. It reduces your RMDs in the future, passes on tax-free funds to the next generation, gives you a tax-free bucket to pull from as well if you ever need it. But one of the big things to remember with Roth conversions is each specific conversion has a 5-year clock. So each conversion follows that 5-year rule that we talked about earlier. So if you were to start Roth conversions in 2025, then you can get your basis out. Let's say you contributed $20,000 to the Roth in 2025. You can always get that $20,000 back out completely tax-free. But any of the growth up until 2030, if you pull that out, that's when you will be taxed on the growth of it. So if it grows to $25,000, you're going to be taxed on that $5,000 in growth. And then each conversion afterwards is going to follow that same 5-year clock. So a conversion in 2026 can't be pulled out completely tax-free until 2031, and so on and so forth. So we've had a lot of conversations around these lately. One of the big things to keep into consideration right now with these is, what it does to your Medicare premium brackets, which I'll let Kathleen get into here in a second, because whenever we talk about taxes, a lot of times, we only are thinking about income taxes, and we're not thinking about the other impacts that our income is going to have on other things in our lives, like our Medicare premiums. And those brackets are a little bit different than what tax brackets are. So we want to make sure that we're keeping both of those in mind. So 2 years down the road, we don't get a premium statement from Medicare and see our premiums have doubled because of what we did 2 years prior, because all of Medicare premiums are based on your income 2 years prior. So your 2025 premiums right now were being based on your 2023 income that you had, or modified adjusted gross income, I should say. So Kathleen, do you want to talk a little bit about IRMA and what it is?
I do. And this is something, again, as Taylor pointed out, that people oftentimes don't think about. And we see this a lot with taking a lump sum distribution from a retirement account, that first year RMD, or potentially a Roth conversion. And this is where the financial planning and looking at not just your current income tax situation, but projecting it down the road to give you an idea of what you might be facing. And the Medicare IRMA, the income related adjustment amount, is based on your modified adjusted gross income, which is your adjusted gross income plus tax exempt income that you may have. These are the 2025 bands. And so, for example, if you are a couple filing jointly, if your modified adjusted gross income is less than $212,000, excuse me, then your Part B premiums would be $185. And as Taylor said, that is based on your 2023 modified adjusted gross income. And you can see how those bands quickly escalate the premiums. So watching and smoothing out your projected income for the next few years could be critical to what you pay in Medicare Part B premiums. You can see there, if you had a big jump, let's say that you converted all of a traditional IRA to Roth in 1 year, and that pushed your modified adjusted gross income up over $750,000, again, married filing jointly, your premium, your monthly Part B premium for each of you, assuming that you're both Medicare eligible, would be almost $630 versus $185 if we had better managed what your adjusted gross income looks like. And again, that's where the Roth conversions with proper planning might give you tax-free income through the Roth, which then isn't going to impact your modified adjusted gross income. So that is huge. And you can see those numbers escalate pretty quickly, really and truly. It sounds like, yeah, going from a 212 to 266, generating $40,000 or $50,000 worth of taxable income through a properly allocated taxable investment program is not that uncommon. So really watching what's going on with your tax situation and having proper investment advice is important. But the other thing is, it's not just the Medicare Part B that can get hit with IRMA. So can your Medicare Part D. And so again, you can go from $0 to almost $90 a month fairly quickly. And you add that on top of the Medicare Part B IRMA, and that may be something that you really hadn't planned for when you were planning for your retirement. So making sure that you know what your income streams are going to be, whether or not the tax-free bucket would be appropriate or could potentially help you down the road, as Taylor was talking about with one of the benefits from doing the Roth conversion. Those things can really add up quickly to not only what your current taxable situation looks like, but also your future income tax. And so you really want to be mindful of all these things that are hitting your tax return in any given year, or what you think might happen down the road. And while none of us have a crystal ball to accurately project it, keeping all of these things in mind is important to your overall financial success in retirement.
Yeah, and the one thing I'll add to that is, there are some instances where you can file basically an appeal with Medicare. It's called a new initial determination, where they can adjust what your Medicare premiums are, what your IRMA is, based off of certain qualifying life experiences. I'm not going to go into the full list of them, but some of the really common ones would be, retirement, a huge change in income because of that, or, a spouse passing away. So just things to keep in mind. If you want to get into more of the details on that, I'm happy to address that kind of individually with you. But there are ways to kind of reduce those premiums if you have had those life experiences. Another thing that I think pertains to a lot of people in this group, your modified adjusted gross income isn't just your adjusted gross income. So it's adding back that tax exempt income. So for this group particularly, I know a lot of you have State Farm municipal bond funds. So even though those funds aren't going to be taxed to you on your income taxes, the interest that those pay out is going to be added back when calculating your modified adjusted gross income for your Medicare premiums. So another tax bucket that we talk about a lot is health savings accounts and what those are. There's some intricate rules around what they can be used for. So for this group, if you're in retirement and you're on Medicare, you can only use those for certain expenses with Medicare. Kathleen, do you want to talk about kind of if people can still contribute to them and what uses they have?
Absolutely. And the health savings accounts are really a great way to help save for retirement, the bottom line. And if you are still working or still under under a high deductible medical plan, then yes, you may still be able to contribute if you are not on Medicare. If you are still in the workforce and you are on Medicare, contributing to an HSA is not an option. The year that you become eligible for Medicare is a different story. Again, if you are still working and covered under a high deductible medical plan, because the HSAs are only used in conjunction with the high deductible plans. So you cannot combine them. If you've got another kind of a flex plan for medical, you cannot combine it with that. And the year that you become eligible and you are going to start using Medicare, there is a calculation that you go through to tell you how much you are eligible to put into the HSA for the year. And again, that's one of those things you need to think about if you are still in the workforce. If you are not still in the workforce, you are not going to be continuing to contribute to an HSA. But if you have money in an HSA and you are retired, you can use funds from an HSA to pay qualified medical expenses, as Taylor mentioned. And part of that could be your Medicare premiums. It does not cover the Medicare Advantage plans, the Medigap. You cannot use HSA funds to pay that. But you could use HSA funds to pay long-term care insurance premiums. You can use it to pay your copay. You can use the funds to pay for testing. So all of those qualified medical expenses are an option for your HSA funds. And the one thing that is nice, if you have contributed to an HSA, you put money in before tax. So that's great. The money has not been, any income has not been taxed to you as it's been sitting in the account. The distributions are not taxed when you use the money for qualified medical expenses. So covering, say you retire and you're not eligible for Medicare yet. You did great planning and you're 62 and you're retiring. You can use the money in your HSA to cover the health insurance premiums that you pay until you are eligible for Medicare. So that's another great planning tool there. So you get the benefit of putting the money in. You've put the money in tax and had the tax deduction. It grows tax-free and you pull it out and it is also tax-free. So they're really great before you get to retirement in terms of the money that you put in. And then after you retire, there also are these benefits. And for example, like I said, if you retire before you're eligible for Medicare, covering those monthly premiums, HSA money can do that. And the other thing is that you can use the money once you get past age 65 to pay for other things as well and not have the tax consequences. So it's we call it kind of the triple, I don't want to say it's a threat, but the triple benefit savings plan for retirement. And it does come in very handy, especially in those initial years of retirement when you don't know how all the income streams are going to shake out or where you're going to draw. Should we draw from the IRA, as we were talking about, even though you're not, you don't have to, or should we take from our taxable account? Should we be taking Social Security? Having the ability to pay some of those initial medical expenses or Medicare premiums, having that money come from your HSA can be a real benefit in those initial years and potentially even later. You can designate, you should designate a beneficiary of the HSA as well, so that that will pass on to a spouse or to someone else in the event that you don't exhaust all the funds during your lifetime.
Yeah, so for a lot of you that have your Medicare premiums that are just taken directly out of your Social Security checks, you can use the HSA to reimburse you for those, except for the Medicare Advantage plans, as Kathleen mentioned. So, if you're getting that automatically taken out of Social Security, you can keep track of the amount that is being taken, and either on a monthly basis or even an annual basis can take that out to reimburse yourself for those premiums.
And I have clients that do that. We this time of year we start looking at what was the total Medicare Part B and D that they paid, and we just go in and we effect that transfer from the HSA right into their checking account for them.
So, all right, well, and we got 2 more slides to go through, and this one's an important one because we've talked a lot about how to gift out of an IRA, but wanted to talk about what are other tax efficient ways to gift funds if they're not inside of an IRA. So, cash is obviously the easy one. A lot of our clients gift highly appreciated stock as well. So, let's say somebody had purchased Apple 20 plus years ago, and the cost basis or the amount that they purchased it for is very low. They can gift that directly to the charity and get the tax deduction for that. And Kathleen, do you want to talk a little bit about what those tax deductions look like for each of these specific items here?
Absolutely. And the key to thinking about this again is whether or not you're able to itemize. And so sometimes we utilize a bunching strategy where you accelerate your normal gifting from the next year. So this is 2025. So we might say, okay, what you normally gift $20,000 a year to charity. Well, let's say we do 40. So you are able to itemize this year. And what does that look like? Cash is very easy. As Taylor said, it is shows up on your Schedule A under charitable deductions. I like those the best. They're the easiest for me to get onto somebody's tax return. The stock, the appreciated stock and mutual funds, those are a great way to move assets out of your account, get a tax deduction for the fair market value. So if the stock is trading, and I'm going to use Taylor's example of Apple, and I have no idea what it's trading at today, but let's say you bought it 20 years ago at $10 a share, and today it's trading for $200 a share. Well, if you are looking to make a gift to charity, Do you want to sell it and incur the capital gains on that? Probably not. So you make the gift of stock to the charity. You get a tax deduction, assuming again that you can itemize for the fair market value of the stock at the time that it was gifted. You can do the same thing with mutual funds, and then you've got a nice tax deduction. And I can tell you also, if it is a tradable, if it's on a market or an exchange stock or the mutual funds, the reporting for tax purposes, you can tell it's tax filing season. I'm really in the tax mode, but the reporting for gifting appreciated stock or mutual funds is very simple. It's a lot cleaner than if you say, for example, you have a Picasso hanging in the living room and you're going to donate the Picasso to charity. So it's, again, it's very simple. It shows up on your Schedule A. Non-cash is a different line, but it's fairly straightforward. Those are things that you can do yourself. You can do it every year, however you want to do it. We talk about the bunching strategy, which I have used a lot with clients since the Tax Cuts and Jobs Act, so that they are able to itemize every other year and get some tax benefit from the gifting that they would normally do. You can also use a donor advised fund, and this really comes into play if you have an unusual event. If you have the sale of, you do sell stock and you've got a large gain, or you have inherited a lot of money and this is the first year that it's been invested, and all of a sudden you're going to have a lot more taxable income because of all the investment earnings. You can set up a donor advised fund, and the benefit of that is you get the tax deduction now. So let's say you had an unusual event this tax year and there was an extra $250,000 on your tax return. In that year that you receive that, if you plan properly, you could make a donation. You could set up and make a donation to a donor advised fund, get that full deduction this year, but still not have to say, all right, I want this much to go here, and I want this much to go here, and I want this much to go here. The donor advised fund gives you an opportunity to really think through what you want to have happen with those funds, but it gives you the ability to do some really strategic tax planning in the year of an unusual event. And Taylor, I know that you have worked with donor advised funds, help clients set them up. The nice thing is that you can fund them with cash, or you can move in appreciated stocks and mutual funds. So do you want to talk a little bit more about how easy it is to do that, and again, some of the planning techniques that you have used there?
Yeah, yes, absolutely. So, I mean, essentially what a donor advised fund is you're donating funds to, it's a qualified charitable distribution. So it's a 501c3. So you can get the charitable deduction, but then you have the ability to decide where those funds are going to be directed after the fact. So, for example, here at Busey, we partner with a company called AEF, American Endowment Foundation. So they are the ones that actually administer the donor advised funds. So you're going to make a gift to them in 1 year. Let's say you sold a business, or in Kathleen's example, you sold a highly appreciated stock and you wanted to reduce the tax liability for that year. You donate that to that donor advised fund. You get the tax deduction in that year, assuming that you're itemizing, and then over the next 5 years or even 10 years, however long you want it to be, then you can decide when and how much you want to gift out of that. In the meantime, those funds can still be invested so they can continue to grow for you, and really just provide a stream of donations for you over the rest of your lifetime, or however long you want to spread it out. So they're incredibly effective tools. They're very, very easy to administer as well. You know, with us, we just open an account here at Busey, and then we partner with AEF to really make those donations down the road. One of the things I'll point out with these is we get a lot of questions on whether or not you can do a qualified charitable distribution into a donor advised fund, since it is a qualified charity. And the answer to that is no, you're not able to. So that is one of the big exceptions to it. But really, they come into play whenever there's an unusual tax year for you, and you want to be able to reduce your tax liability for that specific year, but still be charitable down the road.
And I think the other thing is about the donor advised fund, and I know we've got qualified charitable distributions on this slide, but I think we've talked about that quite a bit. But another use of the donor advised fund leads into the next slide that we have, which is talking about estate planning. And philanthropic planning can be a key part of estate planning. And if you do set up a charitable or a donor advised fund, that money that you contribute into that is moved out of your estate. And that can be huge for tax planning purposes. So right now, what you're seeing here are current figures. The federal exemption is $13.99 million per individual. So if you're a married couple, that's almost $28,000. And that is indexed for inflation each year. But understand that those amounts, that almost $14 million that is exempt from federal income tax, is set to sunset at the end of this year. And if there is no action taken, that amount will revert to what it was in 2017 as adjusted for inflation. And the numbers that I have seen kicked around would be that would go to about $7 million per person, give or take, because they would go back and adjust for inflation. Illinois is at $4 million. It hasn't changed in years, and it is not adjusted for inflation. So it is very likely, we see this a lot on the planning side, clients have Illinois taxable estates, but not federally taxable estates. So that's where that donor advised fund, again, getting things out of your taxable estate. Now, Illinois kind of looks at charitable donations a little bit differently, and we're not going to go into all that discussion here. But on an annual basis, you can also gift. As legally married spouses can gift however much they want back and forth throughout the course of a year, and it doesn't affect anything other than whoever's estate it ends up at the time that there is a death. You can gift up to $19,000 per year per individual. So having worked with Taylor and Matt for a while, I'm feeling pretty generous. So I could give each of them $19,000 a year and not have my federal exemption reduced. Now, because I have worked with Taylor longer than Matt, if I wanted to give Taylor $25,000, then I am going to have to file a gift tax return, no taxes due, but the excess over the $19,000 does get calculated, and it is used to reduce my federal exemption. So again, married couple can gift up to $38,000 per individual. And if you make a payment directly to an institution for paying someone's healthcare costs or educational institutions, those amounts contributed do not come into that $19,000 per year limit. So you could pay someone's $25,000 medical bill directly to the hospital or the physician, whoever it is, and that does not count against your $19,000 that you would otherwise potentially gift to that person. And again, there are no taxes owed on this. When I mentioned a gift tax return, there are no taxes under most circumstances unless you've already used up your exemption, there are no taxes due or paid by anyone, which is great because, again, it's an estate planning tool. If you are going to have a taxable estate, starting to move assets out of your name could be a great strategy. Estate income tax return, you have the 706, which is the federal estate tax return. And again, when you are, if you got a taxable estate over the almost 14 million this year, then you're going to have to file that federal form. If you're over 4 million on the Illinois side, you're going to need to file an Illinois form, which means you're going to have to go through the process of calculating the federal form to get to the number for Illinois. One thing I would say about this, though, is that the federal limit, you do have portability between spouses. So if you've got a combined net worth of 20,000 and it's split evenly, what you want to do is, if the first spouse passes this year, you do want to file a federal form, even though it's under the 13.99 million, because that amount that is not used, if it's $10 million, so they have almost 4 million that they didn't use, gets ported over to the surviving spouse, which in those numbers would give the surviving spouse that extra 4 million to help offset their estate when they pass. What all these numbers look like if things sunset and we go back to pre-Tax Cut and Jobs Act, I'm not even going to pretend to know. So again, these are things that it's important for you to know. And if you do pass, or someone passes and they've got all these assets, even if they're not subject to estate tax, whoever inherits the assets, in the state of Illinois, there is not an inheritance tax, meaning people who inherit are not taxed on that, but they do get the benefit of a step up in basis. So going back to Taylor's example of the Apple stock, you bought it at 10, it's worth 200 at the date of passing. That basis for whoever inherits it steps up to the $200, which means that can be significant tax savings to them in the future when they decide to sell it. So gifting can come into play in so many different ways.
And I think that's kind of a perfect primer into the end of the presentation. And we're going to have another one of these. So our goal is to do 6 of them this year. The next one is going to be around estate planning, where we can get a little bit more in the weeds of the different techniques that you can use for estate planning. So stay tuned, be on the lookout for that. I'm going to look at the chat box here and see if there's any questions that we received, and it doesn't look like we did. So we'll stay on here for a couple more minutes and see if any questions come in. But otherwise, we thank you all for coming and joining us today. And if you have any questions at all, we've got an email set up specifically for the Goldtimers group. That's just goldtimers@busey.com. Any emails that go to that will come to myself and Matt and everyone else on our team here in Bloomington. So feel free to reach out there. We're happy to address more specific situations at that point. So, all right. Well, I think that does it. So thanks again, everyone. Enjoy the day. And looks like we've got some warmer weather on the horizon here for next week. So hope you all can get out and enjoy that. Take care.